Hey traders, Yolanda here with extraordinarytrading.com. In this video, I am going to be reviewing three different order entry types, okay? Most of the traders that I interact with don't realize that there are multiple ways in which you can place your orders to plan your trade entries in advance, okay? So the first order type that I'm going to review is something that I'm sure most of you are already familiar with, and that is a market order. A market order will simply place you into the market at whatever price your broker sends over to you. So say for example, we wanted to buy the pound dollar, we would enter a buy, we would click on this buy button, and we would assume that we're going to get a fill somewhere right along where this sale price is listed. Now, the area in which you need to be cautious is when there is low volume, okay? If you are trading during, say for example, the Sydney session, and you're trading with a broker that doesn't specialize in Forex, and you simply enter a market order, you may find that you get a fill that's pretty far off from where you thought you were actually going to get into that trade. That happened to me years ago. For those of you who trade equities, the same thing applies when there is low volume. If you are trading a stock with a low volume and you simply enter a market order, you may be in for quite a surprise at the price you end up getting in at, okay? In fact, there are algorithms that some institutions use that will really take advantage of the fact that you placed a market order, okay? And so you could lose a lot of money doing that. When there is high volume and a lot of market activity, and you're trading a market such as Forex, and you place a market order type, there's a much smaller risk of you getting in at a bad price, okay? Getting a bad feel. Now, where you run a chance of having a bigger issue would be, say for example, price was making a move to the upside, and you decided to place your buy order here, okay? And it was a buy market order. 9 times out of 10, you're going to get probably the worst fill that you possibly could. And if you check your entry price, you'll find out that your fill, your buy order, was actually up here, even higher than the wick, the highs of the candlestick, okay? So that's an area that you want to take into consideration whenever you are placing market orders. Okay, so this next type of order entry is a stop order, okay? And I use this type of entry every single trading day. There is not a day that goes by where I don't place stop orders in order to get into my trade, okay? So let's assume that price we had drawn this channel here, and price was right in this area, and we weren't quite sure if price was going to break out to the upside or the downside, okay? But we were open to going in either direction, okay? So what you could do is you could place, so right when price is right in this area here, you could place a buy stop entry order at this price. And so what that would do is that if price moved to the upside, it would trigger this buy stop, and then you would be into the trade long, okay? With price moving to the upside, okay? Ideally. The other thing that you could do would be to have a sell stop order, okay? So if you are anticipating that price might break out to the downside, you could have a sell stop entry order, and then if price crossed this line here, it would trigger your sell order and you would be short this pair, okay? Those are two different ways in which you can get into trades where price is not near your entry price, okay? Stop orders are great for breakout entries, okay? And like I said, I use them on a daily basis. So the next type of trade that I'm going to review is a limit order. And I'm going to pull up that chart now. Okay, so let's assume that we wanted to get short the US dollar, the Euro US dollar, okay? Get short or sell, okay? So for those of you who are not familiar with the terms of going long and going short. And let's assume that price was right here in this area and we wanted to sell the Euro US dollar, but we didn't want to sell it at this price. We only want to sell it if we get a pullback, okay? So what you can do in that case is simply have a sell limit order waiting at the price where you want to get in, and then if price pulled back from this area up here, your sell limit order would get filled, and then you would be short this pair as price drops to the downside, and you wouldn't even need to be at your computer or in front of your whatever device you use to trade in order for that to happen, okay? This is another type of order that I use on a daily basis. I use limit and stop orders every single trading day, okay? So now let's talk about a buy limit order. Now, a buy limit order would be placed. So say, for example, the Euro USD was moving to the upside, and I've drawn a Fibonacci retracement here on my chart. But here we've got a pullback to the 23.6% level, okay? So this is a shallow retracement. And let's say that you're like me. I'm a swing trader. That's my predominant style of trading. And so my preference is to get in on trades when there is a more substantial pullback. So I like to get in at the 61.8 or 76.4%. This one says 78.6. I usually use the 61.8 or the 76.4% retracement levels, okay? In this case, okay, we can see the price pull right to the golden ratio of 61.8%, and we could have a buy limit order waiting here. So even if we spotted this potential setup right here at the 23.6% level, we could have our buy limit order waiting here, and our stop loss would be down here, okay, or somewhere in this area, okay? And so that way, when price triggered this area, our buy limit order would get filled, and then we would be on in this trade on the way to the upside, okay? I find that limit and stop orders can be really useful in a 24-hour market like Forex. Otherwise, it can be quite easy to miss trades, okay? So guys, I hope this helps. If you have questions, feel free to leave them in the comments section below. And as always, happy trading.